Should you go for a share purchase or an asset purchase acquisition? The structure of a deal will have a huge impact on, for example, the kinds of liabilities that you will be taking on as a buyer. So in this video, we will be discussing the top 3 differences between a share purchase and an asset purchase so you can make the right decision. Make sure to stay until the end of the video to find out the tax implications of each of the 2 options. If you're new, I'm Malcolm Zoppi, an English qualified solicitor, and I help UK SMEs with their corporate and commercial legal needs. Great, let's jump straight into the top 3 differences. The first deals with ownership and control. When it comes to share purchases, you're buying the shares of a company, and therefore you're buying control and ownership of an existing legal entity. The legal entity remains the same. The only thing that changes is who is the owner of the shares that own the company. Instead, when it comes to an asset purchase, you are buying specific assets from a legal entity. So the legal entity is actually the party to the contract, not the owner of the entity. You're buying assets from that business. To illustrate with an example, a share purchase is when you buy a basket and all of the products that are within that basket. Instead, when it comes to an asset purchase, you are cherry picking some of the assets from that basket and leaving the basket behind. Then we must consider liabilities. When it comes to a share purchase, the starting point is that the buyer assumes all of the liabilities that come with the company, whether those liabilities are known or unknown. That is because the entity remains the same. And for example, if a client who 3 years ago was a client of the company is now unhappy and wants to sue, then you, as the new owner of the company, are going to be responsible for dealing with that claim. Instead, when it comes to asset purchases, typically, you only take on the assets and liabilities that you specifically decided to take on. Before we discuss the last important factor, the tax implications of each of these options, feel free to send me an email if looking for professional legal advice. Great, so what are the tax implications with a share purchase? Well, typically, the buyer of the shares will pay stamp duty on the purchase of those shares. So long as the purchase price is above £1,000, then stamp duty is payable at 0.5% of the purchase price. The seller of the shares might have to pay capital gains tax on the sale of those shares. Keep in mind that a lot of sellers of businesses tend to benefit from business asset disposal relief, which is also known as entrepreneur's relief. Instead, when it comes to the asset purchase, typically the buyer, for example, when buying land from a business, will pay stamp duty on the land that they've bought, and the buyer might also end up paying VAT on certain assets. Now, there are some reliefs. For example, you might not have to pay VAT if it's going to be recognized as the purchase of a business as a going concern, but I'm not a tax advisor and you would need to seek independent advice. Great, so now you have a pretty good understanding of the difference between a share purchase and an asset purchase. But do you know about the different types of mergers and acquisitions that exist? To learn about these different types of M&As, watch this video right here.